Good morning, everyone, and thank you for joining us today. My name is Ashley Brown, and on behalf of KLR and our affiliate companies, I wanted to welcome everyone to our webinar, Tax Planning Strategies, What to Expect in 2020 and Beyond. I know some people are still jumping on here, but we're going to respect everyone's time and go ahead and get started. We understand that 2020 has been an uncertain year on many fronts, and as we head towards year end, we know that you have many questions and concerns navigating the changes. Laura Yalanis is well-versed in the impact of the election and tax implications, and is joined today by Anthony Mangiarelli, who is here to help you understand the effects of said changes on your business. We received the questions you submitted when registering and have allotted time at the end of the presentation to cover them. We just wanted to give you a quick reminder that, as always, a link to the recording of today's session will be sent via email this afternoon. And without further ado, I'm going to hand it over to Laura and Anthony.
Thank you, Ashley. Good morning, everyone. Welcome to our tax planning webinar. I know a lot of you are wondering what tax law changes may be on the horizon. Well, now that we're 99.9% certain that Joe Biden is our president-elect, we can have some certainty in the tax law proposals we'll likely see in the next year or so. But for those of you thinking the changes are going to be swift and dramatic, I'm not so sure that's going to be the case. Remember, tax law change, it needs a simple majority in the Senate to pass. As of today, we don't know what the makeup of the Senate will be. We won't know the answer to that until the runoff elections in Georgia in January. And so we're waiting on that. But no matter what the outcome is there, whether it's a Republican sweep, a Democratic sweep, or even a split scenario, any majority vote to change tax law is going to be difficult at this time, especially while our country is still in the grips of the pandemic and our economic outlook remains uncertain. It would require a strict party line vote where nobody crosses the aisle from either side. That's not an absolute given. There have been plenty of times when senators from either side have broken ranks and joined the other side on a vote. So while we can be certain there are changes coming, it may not be as quick or far-reaching as we think, but that doesn't mean we shouldn't plan. We still need to review the proposals so we can plan and position ourselves for potential changes. So why don't we start out by looking at the areas of the tax code that are most likely to be impacted and that would impact most Americans. So let's just flip this slide here. So we're going to start out talking about the potential changes, and then Anthony's going to jump into some tax planning strategies after I go. So first off, let's look at individual tax rates. When the Tax Cuts and Jobs Act was passed in 2017, the highest marginal rate was dropped from 39.6% to 37%. And that's where we are currently. That rate kicks in at $518,400 of taxable income for single people and $622,050 for the married filing joint group. Those rates are set to, it's a sunset expiration date after 2025, according to TCJA. So after that date, the rates would go back to the rates prior to TCJA. And currently, the top tax rate for long-term capital gains is 20%, plus the 3.8% net investment income tax. Biden plan proposals have said no tax increases for people earning less than $400,000. He would look to increase the top rate from 37% back up to that 39.6% rate. And he's also calling for long-term capital gains to be taxed at 39.6% as ordinary income for individuals with income over $1 million. And the net investment income tax of the 3.8% would still apply on those gains. Child independent care credits. So currently, the child tax credit is $2,000 per eligible child, and that's a child under age 17. Under TCJA, a new tax credit came in for other qualified dependents, and that would be children over age 17, children through 17 through 24 if they're still in college, and other qualified dependents. There's a $500 tax credit for those. Also, there is the dependent care credit. So if both parents are working and they're paying childcare costs, some of those expenses create a tax credit. And that maximum credit as of right now is $1,050 for one child or $2,100 for 2 or more children. That credit phases out once your income levels get higher, and so the minimum then becomes a $600 credit for one child and $1,200 for 2 or more. Under the Biden plan, he has not mentioned anything about changing the child tax credit, and again, that's scheduled to expire in 2025, so no change mentioned there. But he does propose increasing the allowable expense threshold for the dependent care credit, which would increase those minimum credits from $600 and $1,200 up to $800 for one child and $1,600 for 2 or more children. On the itemized deductions and standard deduction front, so this area was one of the biggest sweeping changes under TCJA. TCJA eliminated the phase out for high income earners for itemized deductions. So that is in place right now. But the biggest change, one of the biggest changes for itemized deductions was in the state and local tax area. And currently we have a limit of what we can deduct for state and local taxes, which are your state income taxes, real estate taxes, car taxes. That limit is $10,000 per tax return. That's a big change from prior to TCJA, and it's limited a lot of people in their itemized deduction numbers. Also, mortgage interest limitation, pre-TCJA, the maximum debt limitation was $1 million for qualified home mortgage interest deductions, $1 million of debt, and now that threshold is reduced down to $750,000 for debt. It's important to note that any debt that was incurred prior to TCJA was grandfathered in for that $1 million exemption. And if you refinance that debt after TCJA, it's still grandfathered in for the $1 million as long as you're not pulling equity out on the refi. So still $1 million for the grandfathered debt, but $750,000 for the current debt. And lastly, the other big change was to eliminate miscellaneous itemized deductions, which got rid of unreimbursed employee business expenses, tax preparation fees, things like that. In response to those limitations, the standard deduction was almost doubled for everyone, and that dramatically reduced the number of people who currently itemize. Under the Biden plan, he would reinstate the phase out for high income earners. He does support limiting the tax benefit of itemized deductions to 28% for the upper income people. He would also eliminate the $10,000 state and local tax limitation. And lastly, he's talking about introducing a refundable tax credit of up to $15,000 for first-time home buyers and another refundable tax credit for low-income renters that would limit rent and utility payments to 30% of monthly income. On the gift and estate tax front, currently the lifetime exemption for making gifts and your estate limit exemption for 2020, that threshold is 11.58 million per person. So over 22 million, 23 million actually for a married couple in total for their estate. Currently, the heirs get a step up in basis to fair market value for any assets they inherit. And that would be fair market value as of the date of death. After 2025, that exemption is set to reset back to pre-TCJA levels at $5 million per person. Under the Biden plan, he seeks to eliminate the basis step-up rules. So essentially, anyone inheriting under this plan, if you inherited assets, you would have a basis in those assets of what the decedent's basis was. Now, I can tell you from 25 years of practice and trying to get clients to tell me their cost basis on assets when they sell is a very difficult prospect. trying to figure it out for people who no longer are living is going to be even more difficult. So that is one measure that we're hoping doesn't get through. And also, it is likely that Biden would try to repeal the TCJA exemption levels prior to the expiration date in 2026. So that is something to certainly be considering when you're doing your estate planning with your advisors.
Hey,
Now,
Laura, can we stay on that for a minute, the gift and
Sure.
estate taxes? Just because I don't think people sometimes recognize that this is previously, income that's been taxed for income taxes, and now you're paying a transfer tax. And I think it'd be great if you could remind everybody how high a tax rate that transfer tax rate is, so that you can kind of put to paper the difference between a $5 million exemption and an $11 million exemption.
well, the top estate transfer tax, and again, this is based on the value of your estate, the top rate is 45% at the federal level. And then states, the states run the gamut. They all have different rules. Some don't have an estate tax, some do. In Rhode Island, it's about a 10 to 11% rate there. So you're talking up to maybe 55%, between 45 and 55% at the larger estates if they get to that threshold.
So this could be worth
Planning.
$1 million for somebody if they don't take action before there's a revision to this exemption.
Correct.
Good
Very
tip.
important point. Okay, so those were the provisions that were proposed that would impact individuals. The next few slides, we're going to talk about the business entities. And this first slide is your C corporations. So the current rate is now 21%. It's a flat rate. Prior to TCJA, there was a graduated rate from 15% up to a maximum 35%. That rate is now at a flat 21%. Under the Biden plan, he would seek to increase that flat rate from 21% to 28%. That would certainly make C corporation status a lot less attractive for small businesses and probably push more to go toward the S Corp and LLC route. So look for that. He's also would like to introduce an additional 10% offshoring penalty surtax on any profits for goods and services that were produced overseas but then sold back to the US. And lastly, he does propose a Made in America tax credit. We don't have the details on that, but he has said that he would be in favor of some type of a credit for products made in America. QBI deduction. So this qualified business income deduction was in response to the reduction in the C corporation tax rates. The pass-through entity businesses also were seeking some benefits as well. And this is the deduction that got put in place to help put pass-through entities on a little more equal footing with C Corps and the benefits that they received. So this deduction is for qualified business income, which would come from pass-through entities. Your pass-through entities are sole proprietors, S corporations, not C corporations, S corporations, LLCs, partnerships. And that deduction would be equal to 20% of your qualified business income. And that is claimed on the individual tax return as another deduction below the line of taxable income, or just above the line of taxable income, below adjusted gross income. And so that deduction is scheduled to expire after 2025. The C corporate rate is permanent unless there's legislative changes, but this deduction, it does sunset after 2025. Under the Biden plan, he would seek to expand and simplify the deduction. It is a rather complex area of the tax code that can be, it's complex, so you really need a tax advisor to help walk you through it. So he does look to expand and simplify that deduction. He would seek to exclude rental real estate activities from getting this deduction. Currently, certain rental activities do qualify if they meet specific criteria, but under the Biden plan, he would seek to exclude those rental real estate activities. Also, he would limit the deductions for individuals that earn greater than $400,000. That seems to be his magic threshold, that $400,000 earnings limit.
So Laura, what's tax
Yep.
rate on C Corps versus S Corp? So we're going to go from 21 to 28 on the C Corp. And I think what's important to note is that, the lion's share of, we'll call them, small and medium-sized businesses in this country are pass-throughs. And now with a 20% QBI deduction, and we don't know what that limitation is over 400,000, but we're taking a top tax rate of whether it's 37% or 39%, and we're bringing it down 20%, which brings it to about around a 30-31% tax rate. So we're trying to get some parity with the C Corp and the S Corp LLC pass-through rates. So because I know that's a big question we get quite a bit, is what's going to happen with the QBI deduction, and I think that it's probably going to hang around because it's bringing that parity to the small and medium-sized businesses with the large businesses. I think that's important to note.
Right. And also, you mentioned the C corporate rate at 28%. Let's not forget that to get a distribution out of a C corporation, you're going to pay a second tax as dividend income for money coming out of there. So, that C corp may have a lower overall corporate tax rate, but the individual is going to pay another tax on that income when they take a dividend distribution out of that entity. So yeah, it definitely helps to support more people wanting, at least small businesses, taking that route of the pass-through entities. So on the real estate front, the TCJA did implement some favorable breaks on the real estate side, which, in addition to QBI and the reduced tax rates, one of the bigger areas was to shorten the recovery periods for qualified improvement property. So improvements that qualify for commercial real estate, that recovery period was 39 years prior to the correction that was recently made. We now have, instead of a 39-year for improvements, we now have the ability to write those improvements off over 15 years, which by bringing the recovery period down to 15 years, qualifies those improvements for the 100% bonus depreciation deduction. So there is the potential with that change to write off improvements in the first year of the expenditure, rather than spreading it out over 39 years or even 15 years. So that was a great benefit for the real estate industry. However, there were some unfavorable limits put into place for real estate interest, and that includes the limits on business interest deductions, which isn't specific to the real estate industry. That applies to all businesses, but it does hit the real estate industry a little bit more. It's a little bit more impactful on the real estate industry because they do tend to be more leveraged with debt. And also, there are now more restrictions on net operating losses, can no longer carry back the net operating losses, and you can't do 100% you can't offset 100% of your income with the NOL under TCJA. Now, those limitations have been temporarily suspended under the CARES Act, but those suspensions only go through 2020 as of right now. So those are some of the things that are currently in place for real estate. Under the Biden plan, he has proposed eliminating like-kind exchanges on real property. So eliminating the like-kind exchange entirely. That would be a huge impact on the real estate industry because many investors do like-kind exchanges as just a matter of business to defer their income tax on those sales. Eliminating that would be a very big impact on real estate businesses. He also proposes eliminating the $25,000 special exemption on rental activities that are allowed for middle-income individuals. And what that would mean is losses would be disallowed in the year of the loss unless there's any passive income to offset it. And if they were disallowed, those losses would be carried forward until they could be used. Right now, that $25,000 special exemption does allow the lower income taxpayers, lower to middle income taxpayers, to take some of those losses on their current return. He also proposes increasing the depreciable life on rental real estate and also reforming the Opportunity Zone program to provide more insight and transparency so that more people would benefit, would understand the benefits of it and potentially use it. So that's real estate, and we'll move on to AMT. Currently, there is no corporate alternative minimum tax. That was eliminated under TCJA. That was a permanent change to eliminate it entirely. On the Biden plan, he is proposing a 15% alternative minimum tax, but only on corporations that have at least $100 million of gross receipts and that currently pay little or no federal tax. And lastly, payroll tax. So currently, in 2020, the Social Security wage base for imposing a payroll tax is $137,700, and that is wages up to $137,700 incur a Social Security tax of 6.2% on those wages. After that threshold, Social Security tax falls off; it's no longer taxed, and Medicare is still taxed at 1.45%, and that is unlimited. The Biden plan supports what we call, it would be creating a donut hole, where the FICA tax rules, which is your Social Security and Medicare, Social Security, it would still drop off at the wage-based threshold, but then once your wages reach 400,000, the tax would kick back in. So you'd have a donut hole area where the Social Security tax would not be assessed, but after a certain threshold, he's proposing 400,000, that 6.2% would kick it back in again. So those are the proposals that we're likely to hear in the coming year. Whether or not they get passed is something that we'll have to wait and see. And but we should still plan for positioning ourselves just in case those changes do happen. And so now, to talk about some tax planning strategies for 2020, I'm going to pass it on to my partner, Anthony Mangiarelli.
Thanks, Laura. You know, I guess what I would say is I kind of feel like the 8:30 sitcom where you got the big lead in the 8 o'clock, sitcom, and I'm the 8:30 sitcom, and I just got to get us to Monday Night Football. So this is a lot of pressure. But, thanks for that excellent overview. So prior to jumping in, this is something I've been stressing all year with clients. Anyone I speak with, you've got to make good decisions, whether it's a good business decision, a good decision for your individual and family situation. Don't let the tax tail wag the dog here. We're worried about long-term success, cash flow. Please remember, we're still in the middle of a pandemic, and we're going into, what looks like a period of another potential lockdown and some stress on businesses and earnings. So it's important to make good decisions. So let's jump in with what's on everybody's mind, and let's talk about the Paycheck Protection Program. So the question that we get asked all the time right now is, I received these loan proceeds, I spent them on eligible expenses, and I remember the big push was that under the PPP, if I received cancellation of debt income, I received forgiveness on this debt, that it wouldn't be taxed. And is that correct? It is. But there's a catch, and we're going to talk about that in detail, because I think that's probably the biggest thing I can communicate to you today is if you have a PPP loan, your life just got a little bit more difficult. So let's remember, PPP back March, the world was really coming to a grinding halt. There was a program whereby the government gave out loans, 5.2 million loans to be exact, worth $525 billion, flowing through the economy. Of that $525 billion, 87% of it was loans under $150,000. So a lot of small businesses got impacted by this. So that's why this is important, as well as, less than 1% of those loans were for over $2 million. And that creates a whole other issue with those companies, because you'll see in that bifurcation, the SBA doesn't have the time and the manpower to really look at all these loans. So they're going to focus on those loans over $2 million. But of the 87% of those 5.2 million loans that are under $50,000, while forgiveness may be a little bit simpler for you, you may have a tax situation you weren't aware of. So yes, if you receive forgiveness, the income is not forgivable, okay? However, under Revenue Ruling 2020-32, which references Code Section 265, I'm sounding smart now, I have no idea what they say in great detail, but what they say is that if you receive forgiveness on your PPP loan, the expenses that you paid with that PPP loan are not deductible. So in theory, while the income that you receive from the cancellation of the PPP loan is not taxable, you're not allowed to deduct the expenses that you paid with the PPP loan. So by default, your PPP loan is taxable to the extent of your company's taxable income in 2020. So, that's a big issue. So we've heard quite a bit of people saying, okay, I get that, but I'm not going to get loan forgiveness till 2021. Today's November 19th. I haven't even filled out my forgiveness application. So I'll deduct the expenses in 2020, and by 2021, we'll have a clearer picture on what's going on. So this is the most important slide I have today. Late last night, the IRS released another rev rule in 2020-27. And this is going to put a big, wrench in any plans you had to deduct those expenses in 2020. Essentially, what the IRS has said is that if you have a reasonable expectation of getting forgiveness on your PPP loan, then the expenses that you paid with that funds are not deductible in 2020. So you heard that properly. So, you heard this big push that this loan wasn't going to be taxable. It wasn't going to be taxable. The IRS keeps issuing rulings cementing that, in their opinion, the expenses are not deductible. So by default, it makes the loan taxable. And if you expect to get forgiveness in 2021 down the line, the expenses you paid in 2020 are not deductible. Okay. And then you're saying, well, what if I apply for forgiveness in 2021 and I find out that I don't get forgiveness? I filed a 2020 tax return. I didn't deduct these expenses. The IRS is also saying, well, if that happens, you have the choice of either amending your 2020 tax return to go back and claim those expenses, or you now can take those expenses in 2021. So we wrote a blog on this. We published it this morning. Our correct team of people were writing it probably at 3 a.m. But why this matters is that I can't stress enough that if you think, you're looking at your financials, it's November 19th, I don't have a big tax issue this year, you really need to dive deeper into the numbers. Tax planning is going to be just as essential, if not more, in 2020 than any other year, because cash flow is also important. And you're going to have to make sure you have the cash flow to pay these taxes on now this income increase that you did not potentially expect to have just earlier this year. So I know a lot of people now are ripping out their hairs and saying that doesn't sound fair. So what can we do? What's going to happen? Is there still hope to say that the PPP is not taxable? And yes, there is, but literally it's going to take an act of Congress. Like, it's going to take Congress to pass an act to make that happen. And there's bipartisan support we're hearing from some of our sources to get this done. But between now and the end of the year, who knows if they'll be able to get it done. We've got rising COVID cases. We've got a potential transition of power at the top level. We've got Senate runoff races in Georgia. Unfortunately, I don't know. I don't have a crystal ball to know if the country can get its act together and get this passed. I've asked the magic 8 ball, and it told me it better not tell me now. But it's going to really impact your tax planning, because do you do your tax planning assuming that these expenses are not deductible and make a big fourth quarter payment? Or do you roll the dice and say, I think Congress is going to get their act together and I'm going to assume that they're deductible and I don't pay taxes, and we'll see where things flow in April. And if it doesn't go my way, I'll pay interest and penalties. So you've got to work with your tax advisor, bottom line. And the days are getting short here between now and the end of the year to have these conversations. So I stress, have these conversations. That's your homework coming out of this session. If you have a PPP loan, really start thinking about tax planning.
And Anthony, just to jump in on that, I think that it's important to note that it may take time to see if Congress will do that. And so for preparing your 2020 tax returns, filing an extension might be a good idea to give Congress even a little more time to come up with this potential change. So, for those companies that potentially don't like to go on, or historically don't like to go on extension, this might be the year that they consider that.
That's a great point. If you recall, last year the tax deadline was extended from that April timeframe for many people through July, and we saw that it actually worked better because we had a lot of people that had more time to gather their information, and people that had never gone on extension, it actually made things a little bit easier for them to make sure they were filing a complete tax return and not scrambling in the first quarter. So I would stress that. I think this would be the year to maybe look at going on extension because of this big unknown. So let's move on with another major topic. I know Laura mentioned NOLs earlier. What's an NOL? Well, if your company has expenses that exceed your revenue in a given tax year and you throw off a loss, you have what's called a net operating loss, and you're only allowed to take that loss now after the Tax Act that was passed in 2017. You're only allowed to take that loss and carry it forward to shield future years' taxable profits from income tax. So we know there's a lot of businesses out there that have had a tough year, and I hate to say there's some silver lining here if you've been profitable in years past, but this is a strategy. So if you're saying, well, even with my PPP loan now being taxable, I have no profits, therefore I don't have to do tax planning, I would tell you wrong. I would say with some of the CARES Act changes, you're now allowed to take that loss that you receive or you realize in 2020 and carry it back to 2015, 16, 17 and get back taxes paid in prior years. So this can help you with cash flow. So it's pretty important to look at this. Another thing that matters about this is that when you think about where tax rates were in 2015, 16, 17, they were higher than where they are today and where they may go next year. They were higher. So by carrying back this loss and making the decision to do that, you may be able to take those lost dollars and get a higher percentage back. Because the tax rate was 34%, I get 34 cents back on the dollar as opposed to waiting to next year when it might be 28%, I get 28 cents back on the dollar. So this is an important thing to look at and do an analysis, as well as time value of money. You apply for the refund, you're going to get that refund today. You're going to get that cash flow within the next, call it 6 to 8 months to help your business, as opposed to taking this loss and carrying it forward. If it's a big enough loss, you might not even have profits in 2021 to offset. So we definitely say reach out to your tax advisor. Let's have a conversation, and keep in mind states have different rules, so we got to make sure it makes sense, because in some cases if you carry that loss back, it's not allowed to be deducted at the state level or carried back at the state level. And who does this benefit? Honestly, any entity, any person that has a loss, we encourage you to have a conversation with your advisor, because it could benefit you. But keep in mind, it does impact other items. So if you've got some foreign income or certain other items, it could impact that. So also important to have that conversation early and often.
Anthony, before we leave the net operating loss slide, I think it's important to stress that net losses that occur from business, pass-through business entities will flow through. You don't do a carryback at the entity level. Those losses first flow through to the individual's 1040, the owner's personal tax return, and those losses will offset your other income first. So even though you may have had a loss at the entity level, if those losses don't offset your other income on your personal return, you don't have a net operating loss to carry back. And I've had several questions from clients on that, where there's some confusion that with their S corporation, they're thinking they can carry the NOL back at the S corp level, but that's not the case. It's at the individual level, after you've exhausted and used those losses against your other income, which would include capital gain income, interest income, dividend income, et cetera.
And that's a great point. And you mentioned capital gain income. It's important to note, because you've got different tax rates that you're playing with. And, is it 37%? Is it 23%? And that's a big swing if the loss is big enough or if the capital gains are there. So it's important to have these conversations and not wait till after the fact, because you might be too late to take some good strategy.
And that also factors in if you are thinking about increasing losses because you have improvements. Do you take the 100% bonus depreciation or opt out of it? Does it make sense to increase your loss or not? So those are some planning discussions that should be had.
Or stealing my thunder, see, we think alike. That's a great point, is that we're coming to the end of 2020. I know there's not a lot of days left, but when you talk about tax planning, I always hear people say, should I buy equipment? Should I buy trucks? Should I buy machinery? Going back to make smart business decisions, don't purchase something to get a tax deduction. But if you were going to purchase items of large magnitude in 2021, it may make sense to do it now in 2020. Remember that you can finance them and actually take the deduction for depreciation in 2020. And if you could create that loss, you could carry it back and get back some tax dollars from prior years. So that's a good point. And if you did do some significant leasehold improvements in the last couple of years, have that conversation, because we've had some situations where we've been able to do some carryback claims because somebody had some big leasehold improvements in 2019 and didn't realize that they were going to get this benefit from it. And it helps with cash flow when you can go back and get those tax dollars that you've already paid. And with the change that Laura talked about earlier with the leasehold improvements, by now being able to take the bonus depreciation on it, it's a big win, because when you do leaseholds, we're not talking, a few dollars. It's usually a large size magnitude dollar of improvements. So let's move on to the employer payroll tax deferral. This was something that came out in the CARES Act, whereby you were able to essentially defer paying the payroll taxes on your employees' wages for a period of time in 2020. And they said you could pay back 50% of that amount by the end of 2021 and 50% back by 2022. So essentially it was an interest-free loan that you had throughout 2020 to use some funds to help bridge the gap if your business was suffering. But now it creates a planning opportunity. So if you received a PPP fund originally, you were not allowed to take this benefit, but then there was some clarification that you could in certain cases. Some of the larger companies that weren't eligible for PPP loans definitely did this. So why does it matter? Well, if you've got a profit, we're looking at the end of the year now, and you're like, how do I get rid of this profit? And you've got this interest-free loan sitting on your balance sheet. You might want to make a decision to maybe use it strategically to get a tax deduction. So if you're a cash basis taxpayer, you get a deduction when you pay an expense. So you might be able to say, okay, I'm going to pay this back in December of 2020. I'm going to pay these payroll taxes in December 2020 instead of waiting until 2021 or 2022. And if you cut the check by the end of the year, you'll get a tax deduction. So if you're sitting here now saying, you know, I've got to get a couple tax deductions, where can I find them? You're going to have to pay back this money anyway in 2021 or 2022. Maybe you write the check in December. So that's important to note. But you know, some of the larger companies are saying, well, I'm accrual basis. That doesn't work for me. And here's where we think there's an opportunity. So the way the laws are written with accrual basis taxpayers is that, you know, typically you get a deduction in the year whereby the transaction is realized or recognized. And with payroll taxes, there's actually a you know, some guidance from the IRS that came out way back in 2007, and it basically says that if you pay your payroll taxes by the extended due date of the tax return for which you're claiming that deduction, you claim that deduction. So essentially, if you wait until, as Laura mentioned, we're going to extend tax returns, and you extend your corporate tax return so that it's due September 15th of 2021, you have until September 15th, 2021 to pay the deduction, to pay the payroll taxes and take the deduction on your 2020 tax return. Alternatively, you can wait until September and make a decision and see how 2021 plays out, because maybe you need the deduction in 2021 and not 2020 anymore. And you can wait until September 16th and pay the payroll taxes. So the beauty with accrual basis taxpayers is you don't have to make this decision today. You really have the benefit of hindsight to determine if you want to make this as a 2020 or a 2021 deduction. And I'd also stress that this is true with, you know, for instance, with like a retirement plan contribution. If you're on the fence about making your employer retirement plan contribution, you have the benefit of extending your tax return and making that contribution in, you know, funding it in the form of cash by the due date of the extended tax return. So that's always a little tip to look at, in that I need a deduction for this year, but I don't have the cash. But now I have 9 months to come up with the cash and take the deduction in 2020. So just important to note, that's another tax planning strategy to look at. As we said, accrual basis taxpayers, you have the you really have the benefit of hindsight. But now there is a catch. Nobody knows how to do this. Nobody knows how to fund this. The government hasn't figured it out yet. So the payroll tax forms 941, 940, the payroll companies, nobody knows how to make this payment. We've spoken with the ICPA. They're pushing the IRS to address this because they know there's a lot of taxpayers that are in this position saying, hey, I'm staring at this deduction. I'm a cash basis small business taxpayer. I want this deduction. So the IRS is working on it. Moving on, qualified disaster relief payments. So what is this? So we've got some clients that are actually having their best years ever, believe it or not. They're in an industry where you know, they're just a good vendor towards pandemic-stricken industries, and so they're having great years. We've got clients whereby now most of their staff are being forced to work from home. So what is a qualified disaster relief payment? Essentially, you can reimburse your staff. You can make a payment to them for reimbursement of expenses incurred that are necessary and reasonable, and it's not taxable income to your employees, and you get a tax deduction for it. So because this is a nationwide emergency, you're allowed to make these payments. you get the tax deduction as the company. Your employees get the funds. It's not taxable to them. And it's really going to be something that's necessary and reasonable reimbursement for costs incurred. And a lot of people have incurred costs to deal with the pandemic. They're working from home, maybe PPE, different items you've incurred. So take a look at this. We advise you to speak with your tax advisor now, because if you want to make these payments between now and the end of the year, because you've had a good year, you've got some extra cash, you want to reimburse, not reward, reimburse your employees for the costs they had to deal with the pandemic and the work situation. We encourage you to explore this. Keep in mind, we're recommending you may want to suggest to your employees to submit documentation to you for the reimbursement, so you're not just writing random checks, because the government says they're not really going to examine this in great detail, but who knows if there's cash flowing that's not taxed. So talked about a couple big things with the PPP, NOLs, a lot of opportunities. Can't stress this slide enough. There's a big opportunity that was just further cemented with the IRS in Notice 2020-75, that this is in fact a very strategic tax planning initiative. So as Laura mentioned, if you're an individual taxpayer, your Schedule A itemized deductions for state taxes are limited and capped at $10,000. And what goes into that $10,000? Well, it's the state income taxes that you pay, your property taxes that you pay on your house, and your tangible taxes that you pay on your automobile. And it's very easy to get over that 10,000 number. It's even easier if you are a pass-through business and you have a K-1 that flows to you, and you have this big call it business income that shows up on your 1040, and you're paying state income taxes on it. Well, there's a strategy out there whereby the pass-through entity, the LLC, the S Corp, can now pay your state income taxes and take the deduction at the entity level. So now if you're paying, you got a $210,000 state income tax bill, and I know it's a big number, but let's say you have it, and let's look at an example. If you were paying that at the individual level, you'd only be allowed to take a $10,000 federal deduction on that, okay? Whereby if you enact this provision and you pay the $210,000 at your entity level, you're now getting a $200,000 deduction for IRS purposes that you wouldn't have gotten if you didn't pay this at the entity level. And with top federal tax rates in 37%, I mean, this could be worth substantial dollars. We're talking, this example I just showed, this is almost worth $75,000 if I do the math correctly. I mean, that's big. But I caution you, this came out late in 2019 as a potential strategy. The IRS was like, we're not really sold on it yet, and we were very conservative with it because you potentially could have lost any deduction if you did it, and cash flow was an issue because it came out late in 2019. You'd already paid your quarterly estimates. So we advised a lot of clients, to make a decision, and many clients did not do this because of the significant uncertainty around it. Well, just last week, 2020-75, the notice was passed saying the IRS is okay with this. And so now this is a great strategy to use between now and the end of the year. But I caution you, if you've already paid your state income tax estimates, you may have to expend some additional cash flow to get this benefit, but it's definitely a home run. And we advise you to talk to your tax advisor sooner than later before you make that fourth quarter state estimate at the individual level.
So
Yep.
Anthony, I'll just add to that the strategy only works if your business is operating in the states that have implemented this program. And as of right now, There are only a handful of states that have implemented this. Those around us are Connecticut, Rhode Island, Massachusetts does not have this program in place yet. But given the IRS notice from last week saying that this will be allowed, we can anticipate that a lot more states will jump on the bandwagon with this and come out with a program to allow it. So stay tuned on that, but for at least for the businesses in Rhode Island and Connecticut, this is already available and we should be taking advantage of it with our clients.
Great. So let's move into some individual tax strategies. So do I max out my 401k or a simple IRA before year end? Do I move my IRA to a Roth? Does it make sense? Once again, coordinate your investment strategy with your tax strategy. You know, how close are you to taking distributions? You know, what's the bracket differential on the Roth if I convert it today? Do I have the cash to fund these vehicles? Because once they're in there, if I'm not 59 and a half and I try to take money out, there's penalties. So we tell you, you know, you've got to coordinate. The biggest thing with these is your investment strategy with your tax strategy. Now, RMDs not required in 2020. Should you consider taking a distribution anyway? Once again, do you need the cash? Where do you think investments are going to go in the subsequent years? So this is all questions you have to ask yourself before you say, do I do this? Is basically what I would say. Capital gains and losses. You know, we don't have a crystal ball as to what's going to happen at the tax level for capital gains. President-elect Biden has made some strong statements that he expects the capital gains rates to go up. But it comes down to, what do you think your investments are going to do? Do you want to memorialize the gains today? Do you want to repurpose your investments? So, you know, it goes back to, it's not just a tax strategy. You have to take everything into account. Timing of income and deductions. Where do you think rates are going to go? Where do you think we think they're going to go up? So we say, okay, if you're teetering on that, okay, I'm close to the standard deduction, which are much higher this year, you know, 24/8 married joint. Do I make that charitable contribution at the end of 2020? Do I wait till 2021? You want to bunch your deductions so that you can get them in years where maybe you're not itemizing to kind of get you over that threshold. Do I accelerate income into 2020 or 2021? I tell you that we know rates are going to go up. So if you've got that opportunity to legally move income into a year where you're going to pay a lower income tax and you're okay with the cash flow on it, go ahead and do it. You know, charitable donations, I just mentioned. Once again, I stress, don't, you know, tax strategy is great. You make a charitable donation because it's you know, it's your moral compass. You want to do it, and that should always drive it. And if you get a tax deduction, great. But maybe look into a donor advised fund where you can kind of bunch, you know, your contribution into a year whereby you're not itemizing, and then you put it in the donor advised fund, and you have the ability to make those donations subsequent after the year end to preserve the tax deduction. But really, you make a charitable donation because, you know, it's the right thing to do, or it's a cause you care about. So I'm going to jump off there. Like I said, your homework is definitely year-end tax planning. If you got the PPP loan, consider it taxable as of today. That could change with an act of Congress, but as of today, consider it taxable. Create those NOLs, take a look. Maybe you can carry them back. The SALT payments is a big thing to follow up on. I would also say, if you received any other federal government funds, non-PPP, you may have a single audit requirement. We did a webinar on that on November 5th. It's cataloged on our website. But if you received any other funds outside of PPP from the federal government, you may have some reporting requirements. So, you know, definitely reach out to your advisor on the accounting side on that. As Laura mentioned, leasehold improvements, if you did them, let's explore potentially bonus depreciation on that, so that maybe you get the NOL. Employer payroll tax, if you took advantage of that, maybe pay it back, or maybe keep the strategy if you're accrual basis to revisit it next year, but extend your tax return. And you know, there's all other stuff out there. we're doing things different because of the pandemic. I would tell you, if you've kind of changed the way you do things, maybe explore the R&D tax credit. And I know Laura's going to talk more about that, but you know, I'm going to jump to Laura and she can kind of talk about some other things.
Okay, well, we've got about 5 minutes left to our session, so we're going to go a little quickly here because I want to get to the questions. So what should you know looking beyond 2020? And Anthony really kind of touched upon many of those things. So first of all, make note of the things that you could potentially benefit from. If you have NOLs for either 2018, 2019, or even 2020, consider if these losses should be carried back 5 years or elect to carry forward only. And I won't go into much detail on that because Anthony covered it pretty well. Secondly, for individuals with taxable estates, now is the time to be planning. As we talked about earlier, if you lose out on potentially 6.58 million of an estate exemption, those are real dollars that correlate to an estate transfer tax. So planning for major gifts at this time is really important. You should be talking to your financial advisors, talk to your estate planning attorney, and of course, be talking to your CPA as well. So those are some of the things to be looking at beyond 2020. And then, you know, relief packages. Anthony, I'll let you talk about that.
I think the big thing is we're still in a holding pattern. There were funds appropriated for the PPP that weren't spent. So will there be around 2? We're hearing, you know, we've talked to people at the ICPA. We're hearing that something's going to happen, or we expect something to happen, but there's just a lot of uncertainty with Congress right now with COVID. And I would just tell everybody, you know, plan for the worst, but hope for the best for 2021. 2020, a lot of people repurposed their vacation dollars and that carried us through a strong economy, but who knows what the first quarter of 2021 is going to look like. So just plan appropriately. And so, yeah, let's move into some of those questions. I mean, you know, I'll take the first one, Laura. You know, the future of the QBI deduction, we covered it. You know, something will change with it, but we just don't see it going away. And, you know, the PPP loan forgiveness will be deductible. As I said, act of Congress is the only way to have that happen. You know, I'll just jump through the next 2 quickly. Estate tax exemption going down, because I think Laura just talked about it. Would it be retroactive to 2020? No, but 1/1/2021, possible. You know, because once Congress, you know, it gets back to work next year, and the president-elect, if he gets in, that could happen back to 1/1/2021 at the earliest.
I will say though, it would be unlikely that it would be retroactive, because if people made plans and made gifts prior to any tax law change, it would be really difficult to make that tax law retroactive and basically eliminate the benefit that people thought they were going to get under the rules when they were making these gifts. So maybe unlikely to 1/1/2021, but stranger things have happened.
Yeah. Next question, if a spouse has not contributed to a 403B, can they create and contribute to a Roth IRA, and what would be the max allowed? This is a very individual situation, because the answer is yes, but it really matters on where your income levels are. So there's a second component to it. So I would say the answer is possibly, probably, just got to watch the income levels, and we could help you with that.
Okay, so you flipped too fast. Go.
No, you're
I'll
good.
Go back. Oh, okay. So question, we sold our house and moved to Florida. Can we write off moving expenses? The answer is no. Moving expenses are no longer deductible. However, I'll qualify that. They are deductible if you are an active member of the U.S. military and the move was required by the military to permanently change your station. That's very limited, but for the most part, moving expenses are no longer deductible. Okay, so next question. I became a consultant this year with no retirement option. Should I open a SEP to lower taxes? So there are several options that you have to open retirement accounts. You could do a SEP IRA, you could do a solo 401k, a simple IRA. Those are some of the common ones. And the answer to your question is, if you have taxable income and contributing to this retirement plan would help you save taxes and also help you save for retirement, then it would be a good idea. But I encourage you to talk to your tax advisor and your investment advisor before you set up any one particular plan to see which one really makes sense in your situation. Should we be looking into R&D tax credits? Absolutely. Even if your company is not profitable this year, you could still qualify for some of those R&D tax credits. And the benefit of that is you can either carry them back a year or carry forward. So it's still something to look at. And whether if you're doing research and development type work, you should definitely explore whether or not you can benefit from these credits. Next slide. I believe that due to COVID, we are not required to take an IRA distribution this year. Is this true for beneficiary IRAs as well? Yes. The required minimum distributions for 2020 have been suspended for all IRAs. So even if you are under age 70 and a half, but still required to take IRA distributions because you inherited that, you are eligible to not take out your RMD this year. Is it likely that capital gains will be taxed as regular income? We touched upon that. It's possible. I don't know how likely it is. We'll have to wait and see. Is there any hope that the stretch IRA will return? The stretch IRA you used to be able, under Pre-Secure Act, which was passed earlier this year, IRA owners could take distributions out over their lifetime. Under the Secure Act, that has been changed. We no longer have the stretch IRA. They have to be taken out over a 10-year time frame. So I haven't heard anything about that going away. It's only been into play now for about 10 months, but I haven't heard anything about the stretch IRA returning. Next question. I turned 70 in 2021 and will be required to start mandatory IRA withdrawals in January of 2022. Well, that's not the case anymore. You actually have until age 72 under the Secure Act. So 70 and a half has been extended out to age 72. What should I do to plan for this? Well, you want to make sure that you're having the appropriate amount of taxes withheld from those distributions and or adjust your quarterly estimated taxes. You also want to talk to your investment advisor to see if there is a better investment strategy to change the type of income that you will be getting once those RMDs start flowing. Anthony, I'll let you take the last slide.
Perfect. Should seniors' strategy now be convert IRAs to Roths and make large charitable contributions to avoid higher future tax rates? Every situation depends. I mean, we talked about that earlier. It depends on how close you are to taking, distributions, what your investment strategy is, what your cash flow needs are. So really, it depends. Tax consequences for PPP loan proceeds that are forgiven for an S-corp. We covered that in great detail today. The answer is yes, as of today, that could change tomorrow, there'll be taxes on it. And does someone have the ability to carry 2020 losses back over previous years? As we covered that today, yes. If you're a C-corp, definitely can go back. If you're an individual, it first goes to any other income you have on your 1040, and then you can potentially carry it back at the individual level. So with that, just some final thoughts. Just please allow me to thank everyone for giving us your time and attention today. And let me thank all our clients for allowing us to, provide services to you and you putting your trust in us. Also like to thank our referral sources for holding us in such a high regard, as well as everyone, here, their friends and family who have really helped us up as we've worked very tirelessly throughout this year. Many of you know Laura and I from the firm or through the community. But I can't stress enough that we have such an amazing team of advisors behind us that are holding us up, that make this all possible, as well as our support staff. And our amazing marketing team headed by June Landry and Ashley Brown. I mean, we've done many webinars to share, so many blogs, keeping people informed, all cataloged at our website. Please visit it, conlitwin.com. I'd also stress our IT team. We've been completely remote since March 14th, and it's going fabulous without a hiccup. We're able to provide services seamlessly. And more recently, our HR team, which I can't stress enough. I've had people saying, I got a call last night. It's, hey, I got a COVID case in my warehouse and Cyber Monday's days away. What do I do? And this is 7 o'clock at night. Our HR team is available. Our internal HR team is available to speak with you, to help you with your HR needs. So I would also stress that that's a new service we've rolled out this year. And I just would be remiss if I didn't say that we're very thankful for our clients, and we're always looking for new opportunities and new clients. So please consider us when possible. And I'll just end it with, when I had my first child, they told me that the days were long and the years are short. I can't stress enough that as of November 19th today, the days are short and the year is short for what's left. So let's get going with us. Please reach out to us. And if we don't speak to you from all of us, please have a happy holiday season and find some joy in everything you do. So Ashley, take it away. Thank you.
Thank you, both Anthony and Laura. That's going to wrap up our formal presentation. We hope everyone found this helpful and informative. And as Anthony mentioned, we have a number of articles being published on year-end planning on our site. We have our year-end tax planning guides for individuals and businesses that will be coming out soon. And we hope to write some blogs on any questions that we didn't have time to get to today. So please keep an eye out for that on our website here at conlitwin.com. And we'll be sending out a link to a copy of the PowerPoint and recording of the webinar this afternoon. As always, please feel free to reach out to us if you have any questions. Laura and Anthony's information is here. They are here to help. And thanks again for joining us. Have a great day.